Hey guys, it's Brandon here, and we're on site today at 310th, a boutique hotel right here in Myrtle Beach, South Carolina. Now, this deal behind me, we're talking $1.5 million in appreciation over the next 5 years. We're talking about a $2.8 million net proceeds once you sell this thing. We're talking about an equity multiple of 2.95. That's almost 3 times. For every dollar you put in this thing, you're getting right at $3 out of it. The location is phenomenal. We are just right up from the SkyWheel, right here in Myrtle Beach, South Carolina, which is an historic landmark in our area. Plus, we're right up from where the Country Music Festival takes place. That's a parking deck just right there that handles all of the parking in this area, because Ocean Boulevard is literally blocks away. I'm going to take you on a short walk to show you how close it is. The location is phenomenal. Now, in this video, I'm going to break down a profit and loss statement for the current year, 2025, year to date. You're going to see the gross, the gross income, all the operating expenses, and of course the profit at the end, and it is nice. We're also going to hop into a 5-year pro forma where I break down, again, all of those operating expenses, all of your growth assumptions. I'm going to show you just how much net operating income that you can get out of this thing, as well as the equity after your annual debt service. Yes, I'm going to break down all your mortgage data. We're going to look at your taxable income and find out how this investment is going to impact you on your taxes. And we're also going to look at the cash flows, both before taxes and after taxes. I have analyzed this investment to bring to you everything that you need to know. I've put the entire model together to include key performance indicators, which I'm going to cover with you extensively, from occupancy to average daily rate. You name it, I've got it in there, guys. I've built the whole model for you and treated it just like an investment that I would buy for myself. So if you want to get educated on one of the best boutique hotel deals in Myrtle Beach, South Carolina, well then get ready, because in this video, you're going to find just that. Now guys, you have to watch the must-see investors playlist on my channel, where I have interviewed lots of investors that own many properties in our market. It's got all those nuggets when it comes to the short-term vacation rental game that you want to be exposed to. From Matt Freeze, who's a lender that owns 11 oceanfront condos, to Gosha Cook, who owns 24 properties, both commercial and 15 oceanfront condos, and some long-term rentals. These investors share the nuggets of truth that you want to know about the short-term vacation rental game. So please check out the must-watch investor interview playlist on the channel. Now, guys, hit the like button, hit the subscribe button. It helps me out a lot. Drop me a comment. I'll do my best to respond to as many comments as possible. I don't want to hold us up. Let's get in here and check out this amazing deal at 310. You'd like to invest in commercial real estate. I'd like to show you how these properties make profit and break down all their expenses so you understand how they operate, how they appreciate over time, and how this will impact your taxes. I'd also like to let you know the property's cap rate and how it compares with similar properties in the market, how the location best services its users, and the potential for future growth. I'd like to fill you in on the historical and future occupancy trends, as well as potential management structures affecting the investment. And we won't miss the investment's risk profile nor the best exit strategies. Yes, we'll cover the condition of the property, any value add potential, and repositioning, but we'll also dive into special topics like customer base, market positioning, and marketing and booking strategies when it applies. And if you stay tuned until the end, I'll show you my top picks for the best commercial real estate deals that have generated the most annual profits, have the highest appreciation, and the best tax implications. So no matter if you're a first-time investor or a seasoned professional transitioning into the real estate game, or perhaps simply a casual investor looking to relocate to the beach to live, play, and invest so that the passive income can support you in your retirement years, whether you have 20% to pay down because you're financing, or you're a cash buyer, if it's a commercial real estate investment that you're after, you'll be better because I'm aiming to give you a 10 times return on your time for watching my videos until the end. Guys, we are on site today right here at 310th, a gorgeous 29 unit hotel right here in a phenomenal location in Myrtle Beach, South Carolina. Now guys, look at that. That's the SkyWheel. Do you see that? That's a historic landmark. That's the backside of Ripley's right there. Obviously there's a sign for the gay Dolphin there. This is a parking lot just here. That's the back of the Ripley's building, and literally on the other side of this road, like if you come right there and make a right, that is Ocean Blvd, which I will walk to in just a minute. Now you'll see off in the distance there is the Aqua Beach Inn, and then that building right there, that is the Yachtsman. So you can see just how close to the coast we are. Now let's get a good look around 10th Avenue. It's a phenomenal location. It is not too far south to scare many investors. To be honest with you, the location is phenomenal. This property does great with short-term vacation rentals. As you can see, 29 units here. Someone bought it a few years ago, a previous investor, and redid it, fixed it up, remodeled it, added a lot of value to it. We're going to get inside and check out some units in just a minute. I just want you to see real quick. We got a front office right up here, courtyard area here. And if we head this way, you can even see they have a pool set up. Absolutely stunning right here on site. I'm going to take you around just real quick and show you the other side of it. Now that is a parking deck. Again, this is a very busy area of Myrtle Beach, South Carolina. Busy enough to warrant a parking deck, which again just shows you why this site is an excellent location and has a ton of potential. Now, this is the front. As you can see here, they got some commercial space for lease down below, which is another income stream that we'll get into for the property once we go over the model for it. And then you have a neighboring little spot here with a fence. All American Ads is what the sign says, just right next door. I believe you should invest in commercial real estate in Myrtle Beach, South Carolina, especially in multifamily properties because of the strong rental demand from a growing population. The city's population grew by over 20% just in the last decade, with a significant portion of new residents moving here due to the low cost of living, warm climate, and access to beach amenities. I believe you should invest in commercial real estate in Myrtle Beach, South Carolina, especially in multifamily properties because of the tourism-driven economy. Tourism accounts for over 25% of the region's economy. The demand from tourism-related workers ensures a steady flow of renters in multifamily units year-round. I believe you should invest in commercial real estate in Myrtle Beach, South Carolina, especially in multifamily properties because of the affordable property prices and high cap rates. With an average cap rate for multifamily properties being typically around 7 to 8%, our market is higher than national averages for coastal areas, offering strong rental yield potential. I believe you should invest in commercial real estate in Myrtle Beach, South Carolina, especially in multifamily properties because of the potential for value-add investments. Many properties near the coast have strong locations but may be underperforming due to outdated facilities or lack of amenities. Renovating these properties can create significant upside for potential investors. All right, guys, so let's get in unit 108. As you can see, beautiful flooring. As soon as you come in, the inside of the unit's been totally redone. You got some nice recessed lighting here. accent wall. Obviously 2 full-size beds, flat screen, closet. Now, we're going to get to the other side. That's a lockout there. However, I want you to see the ensuite shower, restroom. All right, so it shares a kitchenette. As you can see, you got a flat surface here. Oh, I didn't mean to turn that on. Let's get that off. All right. As you can see, absolutely modern, stunning. Behind me, microwave, coffee pots, another exit entrance here, and then the second lockout unit, second part of the unit here. Again, microwave, little fridge, flat screen, and its own restroom here. And that pretty much wraps it up. All right, guys, so we're on the second floor. As you can see here, there's the pool. Some stairs, got a stairwell here, as you can see. Got a little courtyard area here, as you can see. Peak of the peak is going to be June, July, and August for those peak season months for short-term vacation rentals in our property and our market. Now, as you come in here, you are going to see really quick, this is electrical water heater. All right, guys, we're in the hall here just outside of unit 222. As you can see, you walk in, full-size beds. To the right, you do have kitchenette. Of course, there's a flat top stove, nice undermount sink, cabinets. You do have a closet in the corner here. Recessed lighting again, accent walls, restroom here, tub shower combo. And of course, this unit does have its own balcony, as you can see. Some of these units do have balcony. Now, this is where, if you look down that road, you can't really see it from here. Parking deck's here because it is a very busy area. Country Music Festival is just down that road. Over 40,000 people come here for a few days, which again makes this property sing during that time of the year. All right, guys, so you can see the courtyard here and the upstairs. We're going to get into unit 229. This unit here is, in my opinion, an owner-operator unit, honestly. I mean, it's absolutely stunning. You walk in, you have a nice living room. As you can see here, it has a balcony, which is pretty cool. Of course, overlooking the entire place. As the owner-operator, you're obviously going to want to be able to see everything and what's going on. These windows are shut, but obviously some nice open natural light. Plenty of kitchen space, refrigerator, stove, microwave. As you can see here, gorgeous quartz countertops, modern cabinetry, undermount sink. Again, plenty of natural light. You do have a restroom here with shower, as you can see. Again, tastefully done, very modern, very, very clean. Now, this was another sitting room area. They've converted it into a bedroom, again, in keeping with their current rental model. You have another bedroom here, as you can see. And then you got a final bedroom here. This is the master. And again, this would be a perfect little owner-operator on-site living quarters for the boutique hotel that this can be. That's your balcony. Again, recessed lighting, accent walls, king-size bed. Not bad. Not bad at all.
I believe you should invest in commercial real estate in Myrtle Beach, South Carolina, because our market has been the fastest growing market out of the 150 most populated markets for the past 3 years. Over 90,600 people relocated to Myrtle Beach, South Carolina in 2023 alone. This means increased demand for commercial space like retail, multifamily, office, and industrial, and ultimately excellent annual profits and appreciation. Now, for retail, more residents equal more consumers equal higher rental sales potential. This drives up rents and occupancy in retail centers. For multifamily, higher population boosts demand for rental housing, pushing rents up and lowering vacancy. Now, for office, job growth typically follows population growth, increasing demand for office space. For industrial, more people means more consumption and e-commerce activity, increasing warehouse and last mile logistics demand. Ultimately, the return on investment impact is higher rents, lower vacancy, and rising property values that drive higher net operating income and appreciation. I believe you should invest in commercial or real estate in Myrtle Beach, South Carolina, especially oceanfront hotels in the hospitality industry because of the 20 to 22 million tourists that visit our market each year, which is the number 2 vacation destination on the East Coast. High tourism equals steady demand, making it one of the most visited beach destinations in the United States. Our oceanfront hotels benefit from consistent seasonal occupancy, premium nightly rates compared to inland properties, and repeat visitors including families, snowbirds, and golfers. All right, guys, let's get inside of the main lobby. Now, currently the lobby is not used because the operation is ran remotely. As you can see here, plenty of space for natural light, a nice front desk, beautiful area. Let me get you back behind here. It's a little messy, but nobody uses it, you know? There's nobody here. Everything's ran remotely by the current operator. Now, this is a little housekeeping area, refrigerators, you know, cleaning supplies, sinks and couches. As you can see here, housekeeping, standard housekeeping stuff. Mattresses. I mean, it's here. It's got great flooring, great bones. But technically, this is the first door of 5 doors of commercial, of what could be commercial space on the property. The door is covered. That's the actual door right there. It's covered by these mattresses. But this is where your other income for this property could come. Renting out this space. Oh, and let me take you around here, which is, you know, an easy 1,000 square feet. Then we've got, there's a restroom here. Let me show you real fast. It hasn't really been redone. Here's another 1,000 square feet of space. And that is another storefront. That's a door right there. So, I mean, plenty of space here. Again, commercial space that can be leased. And then you've got this wall here that hasn't been really put in. You've got more space. And there's another door. Then we've got another door there. And finally a door there in that corner. Now, all that being said, this 3 sections are 3,000 square feet. And there's tons of stuff stored in here, as you can see. However, this is easily more commercial space that is currently dead space and not being used on this property. This is a storefront. Look at this. You got 5,000 square feet of space that is really not being used well, which could obviously generate income for this property. This is the hidden gem of the property. Now, that's the lobby. I took you in there. I'll take you out here, as you can see. All right, guys, this is the pool here. There's a little pool house there.
As you can see, 8 foot, 6 foot, 4.5 feet, 3.5 feet, little area for lounging, baking in the sun. I get calls and emails every day from investors just like you looking to make their move into the Myrtle Beach market. They want to invest in short-term vacation rental properties. They want to invest in oceanfront condos. They want to know where the best deals are in our market. Well, guys, you're talking to the right person. 843-360-1737. I'm going to help you put your hands on the best deals in our market. If you're a first-time investor or a seasoned investor, if you're 1 year, 6 months, 3 years out, I don't care where you are in the investing process, pick up the phone, give me a call, send me an email, shoot me a text message, and let one of the many stories on our channel be one of your stories.
In this video, I've shown you the surrounding area and the condition of the property, highlighted the most exciting components of the deal, and given you a walkthrough of the property as well as any amenities. But next, I'll discuss the cap rate and compare this property to other similar deals on the market so that you can understand how it stacks up in gross rental income and depreciation, seeing the competitive advantage for this particular property. Then I'll discuss the location and its potential for future growth, to include local attractions and their influence, what the historical and future occupancy trends are, as well as management, financing, and tax structures so that you understand how the deal is supported for cash flow and depreciation and avoid the pitfalls other investors have made. Then I'll cover the risk profile and the exit strategies so that you don't end up holding the bag, and even dive into topics like value add, repositioning, and marketing, with stories and testimonials of how other investors won big after purchasing underperforming assets. Plus, I'll throw in any boots on the ground information you simply can't get anywhere else. Finally, we'll do a 5-year projection on the property that shows the initial investment required to get into the deal, the mortgage data, the taxable income data, and the cash flow data, as well as 3 different cap rate scenarios for when you exit the investment. Oh, and don't miss my top market picks right at the end, based on which properties have appreciated the most and have the best annual profitability.
Now, guys, I'm going to take a quick walk down to Ocean Boulevard for you to see how close you are to one of the hottest areas in Myrtle Beach, South Carolina, the hottest tourism areas. We have between 20 and 22 million tourists that visit each and every year, and we have been for 3 years running the fastest growing place out of the 150 most populated places in the entire U.S. So literally in just a few seconds, you're going to see how close you are to the hottest action in our market, the main tourism drag area just outside of the SkyWheel. Now, I'm going to start covering a profit and loss statement with you for the current year to date. You got your income at 464, 521, 36. You've got some expenses there, 560 advertising and marketing, 565, 66. Business licenses, 276.25. City hospitality tax, 117.89. County hospitality tax, 3,330.38. It's getting a little loud, so if you hear music, it's because there's music in this area. We're at the little Ripley's walkthrough section. But guys, that right there, that's Ocean Boulevard right there. So you can't beat the location. You absolutely cannot beat the location. There's no way around it. There's demand here for sure. Now, all right, so county hospitality tax, 3,330.38. Insurance, we're at 18,808.92. Legal and accounting services, we're at 2,500. You got some office expenses. You got merchant account fees at 376.90. Software apps at 3,580.16. We have a total for office expenses of 3,957.06. Pest control, $425. Property management fee at $13,935.64. That is very low. I want to find out how they got it so cheap. Repairs and maintenance, we have a total there of $26,711.52. You got some total for taxes paid was $7,320.86. Then we've got utilities. We've got electricity at $19,038.34. Internet and TV services at $5,611.57. We've got phone service at $49.99. Water and sewer at $21,162.85. We've got a total for utilities at $45,862.75. So basically, our total expenses were a whopping $123,811.93, giving us a net operating income. Ultimately, you take the rental income, that gross income, you subtract out the total operating expenses, and that leaves you with a net income of $340,709.43. Now, I'm just going to keep walking to the SkyWheel because we're so close to it. It'd be silly not to, and it's a nice day. As you can see, the sun's out. Plus, I want you to see the surrounding area because this is a hot spot right here in Myrtle Beach, South Carolina. Now, on your screen, you'll see other income. We got some operations information. Essentially, this is the profit and loss statement, but I've added a few extra components for our financial model. You'll see other income at the top. That's $60,000. There's 5 commercial spaces at this property that are not being used. Or excuse me, I should just say 5 spaces that could be used for commercial. It could be leased out as commercial space. You could lease it to one tenant. You could lease it to 5 different tenants at 1,000 square feet a pop. I don't know. You could lease it to 2 tenants, one at 3,000, one at 2,000. It just depends. The point is, I've got you at $1 per square foot, which is cheap. $60,000 extra income for this space. You could possibly get more. The point is, there is currently dead space on the property that's not being used for anything, which is crazy. When's the last time you had 5,000 square feet that you didn't take advantage of? Well, there is value add right there hidden in this property, which makes it it's the hidden gem of the property, guys. It's going to add a bunch of value that's not currently being accounted for. There, underneath that subtotal, you have property taxes. That's escalated for year 1. I've escalated it based off of a growth rate, which we'll cover in just a minute. That's $40,517.94. Last year, if I recall correctly, the property taxes on the property were $38,000 and some change, of course. Now, management. I've got a percentage of effective gross rental income at 3.5%. In other words, I'm saying that if you're really going to turn this hotel into a proper boutique hotel and really go after being, one of the top contenders in the market for your size and space, given the location, which I think it's totally doable, then you're going to need an on-site operator. It currently doesn't have one. It's being run remote from out of state. Yeah, they're turning these kinds of numbers remote from out of state. That's amazing. Anyways, reserve per unit, we're at 1,185. I'm going to break down those reserve funds and the calculation as to how I arrived at that number here shortly. What I did want to show you is the land chart and the SkyWheel literally right here. We've got the boardwalk just in front of me. I'm about to go walk it so you can see it as well. They just redid the boardwalk, and I want you to get a good view of it.
Now stay tuned, because coming up in the rest of the video, I'll discuss the location and its potential for future growth, to include local attractions and their influence, what the historical and future occupancy trends are, as well as management, financing, and tax structures, so that you understand how the deal was supported for cash flow and depreciation, and avoid the pitfalls other investors have made.
Now, these growth rates are going to apply to the pro forma, the 5-year projections I built when you own and operate this property. The growth rates, we got rent. I've got you at 5% on the rent. Essentially, tourism growth is generally 4 to 6% annually. So I think 5% is a nice midpoint. It's totally achievable. Other income, I've got you at 2.5%. I'm saying that you're going to be able to escalate the rent on that commercial space 2.5%, and that fits with local leasing norms. Operating expenses, 3%. Essentially, some people build these models and they don't don't escalate the operating expenses. It's a fallacy. There's inflation, costs go up. You got to account for it if you're being realistic. Now, our region labor rises at between 2 and 4%. Utilities rise between 2 and 3%. So I've got you factored in at 3%. Property tax. Horry County, historically, reassessments happen between 3 and 5%. All that being said, I've got you at 4%. And then vacancy, of course. Basically, the way that you want to understand vacancy for a hotel like this is it's a revenue loss factor, not an occupancy drop. And that's a key insight. So we're not talking about an occupancy drop. We're talking about losing revenue in that average daily revenue. Now, the Myrtle Beach short-term rental market supply, it grows at 3 to 4% annually. In other words, more and more people are getting into the short-term vacation rental game, putting more supply into the market. And if there's more supply on the market, there's more competition. If there's more competition, they're going to steal some of your business if you're not the best. Bottom line. Guys, we're on the boardwalk, but back behind me again is that SkyWheel. What I'm trying to get you to see is, and this is a beautiful park, as you can see, the location, there's the pier off in the distance, and there's shopping. I'm trying not to get you dizzy moving this this camera around too much, but there's shopping everywhere here. This is a main tourist traffic, high traffic tourist draw in the Myrtle Beach market. The location for this property is absolutely phenomenal. You got to see it. Now, I'm going to keep walking us up the boardwalk this way. You're going to see shops on my right. The ocean, we're literally oceanfront. That's sand and ocean right here. Let me show you this. For all of you out-of-state investors, you got to hear me. You can't get better than this location. Not really. The opportunity here for this boutique hotel is phenomenal. And you got to keep watching the video because I've modeled everything that you need to know. Hey guys, now let's cover the historical performance for the property from 2024, 2023, and 2022. Now, again, in 2024, which is last year, they went ahead and switched the model to month-to-month rentals and to some short-term rentals, which proved not to be as profitable as 2023 when they did only short-term vacation rentals. Let's dive into some of those data. Guys, you can see there on your screen, you have all the different months of the year for 2024 in the top left of your screen. You have an average daily rate of 161.97. You have an annual occupancy on average of 56%. And you have a gross rental income number of $674,641.17. Now, some peak season performance options that I want you to be thinking about, because the whole purpose of buying this property, obviously, is to have it function better, to increase revenues, and by increasing revenues, thereby increasing net operating income, and by increasing net operating income, increasing value, which means you can sell the property for a whole lot more. So peak season performance options, you can push the average daily rate higher during the strongest demand months. Now, how do you do that? Obviously, you implement dynamic pricing. You can follow a last-minute booking strategy. Myrtle Beach is a last-minute market. I've spoken to 2 different investors that have confirmed this. They keep their rates higher, and they catch last-minute tourists that will pay a premium for a unit. It's that simple and that easy. So in those peak season months, you keep your prices a little bit higher and you catch those people. I once had a guy, an investor client of mine, he was his first year doing vacation rentals, bought an oceanfront condo. He made $63,000 renting it out first year on Airbnb alone using a last minute booking strategy. It works. Now, you can also, another peak performance measure that a lot of people, for some reason, investors don't think about, and it's probably because they don't, they're used to running it like a hotel rather than running it like a short-term vacation rental, is you put a 1 week minimum stay in. And I know that might seem a little bit silly or strange or odd, and it might work against the conventional wisdom, but the honesty is, during those peak season months, people want to get a room pretty bad. And if that's the case, the majority of the oceanfront condo resorts in our market, they have a 1 week minimum stay. So essentially, you can charge more for the rental and make more money in revenue by putting that 1 week minimum stay in place. That simple, that easy. You run it more like a short-term vacation rental, than like a hotel. Now, this captures more revenue during periods when demand is already high, boosting net operating income without increasing expenses. That simple optimization strategy, those two I gave you, can be huge for net operating income, which again, increase value. Now, let's work through 2023. This year, they focused solely on short-term vacation rentals, and it shows. The gross rental income was $764,367, which is almost $100,000 higher, and I still believe that they could do a lot better. The occupancy was only 58%. Now, it is in keeping with Myrtle Beach. Your average occupancy in Myrtle Beach is about 60%, but top performers are at 85%. So we're talking about leaving 17% on the table, which is a lot. I mean, we're talking about significant increases in net operating income, which equals significant increases in sales price when you go to sell that property. Your average daily rate was $188.53. Now, low performing seasons and revenue recovery options. You can add winter promotions in. Hands down, you can have your on-site property manager or your on-site operator run programs to get groups to come and stay at your place during the winter months. The resorts do it. Why can't a boutique hotel all day long? You can partner with sports tournaments, snowbird groups, or corporate stays. And you can even target golfers. There's over 90 golf courses in Myrtle Beach. Large groups of golfers that want to come and stay. They can be close to the beach and go golf. There's golfing all over the place here. Anyways, so you want to create shoulder season packages. Very, very simple, very, very easy. You also want to improve SEO and pay per click during slow months. Guys, run Google ads. It's that simple and that easy. This is a numbers game. Marketing is a numbers game. It's an exposure game. The more you do, the more exposure you get, the more return you get for your money. It's that simple and that easy. Now, small occupancy gains in slow periods directly increase annual net operating income. And I'm hammering on it over and over again because a hotel is unique in the sense that it is a business as well as a property. And if you increase the net operating income, you increase the value, and you increase the sales price at which you can sell it at, you could gain an extra $1.5 million, $2 million by making these changes. Let's cover your 2022 year. They took it over halfway through the year. That's what the numbers tell me. I have not confirmed that with them, but that's my guess. You can see they don't have any data for the first part of the year. In the last 6 months of the year, they've got data. Even in the last 6 months of the year, they were still at an average daily rate of $188.03 with a 55% occupancy, and they brought in $418,713.90. Now, average daily rate versus occupancy to find... You use average daily rate versus occupancy to find mispricing or unmet demand. If occupancy is high but average daily rate is soft, rates are too low. If average daily rate is high but occupancy is soft, then rates are too high. Now, underperforming months that justify marketing investment. It's important to identify underperforming months, which I've done that. You can see some of those little square boxes there. There you've got a 42% occupancy in June. It should be 85%. That's a peak season month. So it's got a great average daily rate at 227, but the occupancy is soft. October, it's the shoulder season, 30%. It's low. The occupancy is low. December, 51%. The average daily rate, 53.45. So you want to identify those underperforming months to find if your pricing's off or to find unmet demand. Then you want to increase paid search. You want to boost social media presence. I once spoke to an investor that went and joined travel groups and would post his oceanfront condo in travel groups, and he'd make an extra on Facebook. He'd make an extra $10,000 a year in gross rental income just by posting on social media in travel groups. And that's not counting TikTok. That's not counting. I mean, guys, you can do a lot with social media marketing, and it's free. And if you have an on-site operator, you better believe he should be doing it for you. Now, target snowbirds, of course. You want to improve distribution, Expedia, Booking, Airbnb, etc. Now, you'll notice at the bottom, guys, I've got some little 2024, 2023, and 2022 seasonal occupancy performance gap analysis tables. We got your slow season. Your slow season is going to be December, January, February. Your occupancy target, if you want to be a top performer in our market, should be 40%. According to their numbers that were supplied from the seller, one of their months missed that 40% target. Now, if it missed the target, that means that there's room for improvement. If there's room for improvement, guess what? That means that there's value or equity on the table. It's that simple and that easy. Shoulder season, which is March, April, May, and then September, October, November. That's, it's got a 60% occupancy target. They missed 6 of those months. 6. Now, peak season, 85%. That's the occupancy target. They missed 3 of those months. This was last year. Now, granted, they changed the model to a different model, which is not serving them well, in my opinion. They should have short-term vacation rentals as the model for this property. But the point is this, guys. The total months that need to improve are 10, which means there is equity sitting on the table. There's value add potential by optimizing and doing an exterior remodel on this property. Now, 2023, guys, we've got a total of 9 months that need to improve. And then, of course, 2022, we got 6 months. It's kind of incomplete data, only 6 months out of the year, but still. The whole point, guys, is there's room on the table to improve this property. There's equity sitting right here at this purchase price. Now, investment information. I've got you on a 5-year holding period. Your purchase price is $4,250,000. Now, you got some closing costs. Those closing costs, you got commissions. That's 2% of the purchase price at $85,000. I'm obviously not going to build your model and do everything for you without charging you a fee. You don't get this kind of turnkey service free of charge. Anyways, $85,000, that is the commission that the buyer would pay. There's legal. I've got you at $31,500. I'm going to stop real quick in the video and break down your legal fees and stress to you the importance of having an attorney in your corner to review and go over and be a fresh set of eyes and ears on your deal. The right attorney can add substantial value more than what you pay him for. It's the bottom line. Let's get into those fees now. All right, so let's work through your attorney fees. Now, we've got several different components in the table here. I've got a low cost, I've got an average cost, and I've got a high cost. For our purposes, I have ran our legal fees at the low end, at the low cost, because I believe in Myrtle Beach, you can get a good value. You can whittle down the attorney fees and still get a really, really good deal. So, all right, component. The attorney is going to be reviewing and going through and working through with you, with the other side of the deal, these components, the purchase and sell agreement. Obviously, I'm going to be doing that with you too, but I'm going to be working closely with your attorney to make sure we've got all the T's crossed and all the I's dotted. We also have title review and closing cost. You have hotel-specific due diligence. You got contracts. You've got vendor agreements. You got staffing issues. You've got franchise and then flag review if it's a branded hotel, but it's, this one's not a branded hotel, so you don't have to worry about that. You got a management agreement review. Obviously, you want to make sure he's looking over the management structure and the agreement that's in place with the current manager of the property and make sure it's adequate and what you want. And negotiating, again, getting these kinds of things worked out, getting those lender fees lowered, getting those management fees lowered. That increases operational efficiency. And every time that you can increase operational efficiency, cutting cost or doing things cheaper, you're increasing the revenue. And when you increase the revenue on a property like this, you increase the value of the property. Let me just stop for a second and explain this to you. All right, so what you have to understand about a hotel is it is very much a business in addition to real estate. What that means for you is if you increase the net operating income, let's just say by $50,000, and this property, it has a 12.4% cap rate. So let's say you were able to cut some costs, you were able to increase revenue by marketing the property better, maybe you made some value add improvements to it, you made the exterior nicer, which is what I'm going to get you to do. The point is, just a $50,000 increase in net operating income is going to add $403,000 worth of value to the property. So if we increase it by $100,000, then we've almost added $1 million in value to the property. These kinds of properties are priced or valued based on the net operating income. All right, so getting back to our legal fees, guys, you've got alcohol licensing, South Carolina state transfers. He's going to be looking over that. You've got entity formation and tax strategy. Of course, you're going to bring your CPA in, which we'll get to in just a minute. But the point is, on the low end, we're looking at $31,500. Your average, $55,750. And then your high cost is $80,000. I've got you budgeted at $31,500 because I believe you can get that deal done with the right attorney giving you an exceptional value. Now, some big takeaways I want you to have is that an attorney essentially is going to protect you from hidden liabilities that most investors miss. You know, one missed clause can cost you more than the whole attorney's fee. So who cares? Pay him the fee, have extra eyes on the deal, and make sure that you're covering your tail. You don't want to end up holding the bag. Professional hotel counsel often saves, 5 to 10 times their fee by reducing franchise transfer cost, reducing or deferring, property improvement plans. This property does not have a property improvement plan. Removing personal guarantees, softening or modifying management contracts, avoiding costly failures to perform, penalties. In hotel acquisitions, negotiation skill is worth more than legal review. So the point is, you've got somebody else with a different mindset, a different perspective, a different viewpoint, and a very valuable one. That legal context can help you tremendously. It's prudence. Ultimately, that person is going to be looking ahead, thinking through things from a lens that you don't have, most likely, and you need it. Now, hotel transactions have many moving parts that can derail a closing, from loan compliance, lender covenants, franchise approval timelines, liquor license transitions, certificate of occupancy, contract assignments, surprise title issues, environmental findings. The right attorney doesn't just protect you, they make sure that the deal gets to the finish line. Now, guys, you can see the location. Look back behind me. They've put in volleyball courts. They've got it decorated for Christmas now. If you look here, you got the ocean right here. I mean, this is a commercial corridor in our market. The location is second to none. All right, so let's break down your financing information. Your loan amount was $3,187,500. That's 75% of the purchase price. Again, the bank's going to make you at least put down 25% on this deal to get into it. Some might even make you put 35% down. I've ran your numbers here at 25% down. So the loan to value is 75%. Your interest rate, I've got you at 7%. Your amortization, 30 years. Your loan fee, 1% of the purchase price. Your monthly payment comes out to $21,207. Your annual debt service, which we just talked about, was $254,478. And then your loan balance at the end of 5 years was a whopping $3,444. Now, you'll notice up top some of the reversion information. We're going to cover that in just a minute after we talk through your returns on this investment.
Now stay tuned, because coming up in the rest of the video, I'll cover the risk profile and the exit strategies so that you don't end up holding the bag, and even dive into topics like value add, repositioning, and marketing, with stories and testimonials of how other investors won big after purchasing underperforming assets. Plus, I'll throw in any boots on the ground information you simply can't get anywhere else. Finally, we'll do a 5-year projection on the property that shows the initial investment required to get into the deal, the mortgage data, the taxable income data, and the cash flow data, as well as 3 different cap rate scenarios for when you exit the investment. Oh, and don't miss my top market picks right at the end, based on which properties have appreciated the most and have the best annual profitability.
Now I'm going to walk you just a little bit further on down so you can continue to see the location. Now, as we keep going, we've got legal, then we've got due diligence. I've got $10,000. We're talking about permits and CPA fees. You want your CPA to make sure your tax stuff is where it should be. You want your CPA to be looking over all the financial statements and, running, business analytics, essentially. You want to make sure that you've crossed every T and dotted every I, and the more I's you can have in the deal, the better for you. Now, total closing costs, I got you at $126,500. The closing cost percent of the purchase price is 2.98%, which is very, very low. It's in keeping with norms. Your working capital, I've got you at $37,144. Your reserves, I've got you at $34,369. Let me show you how I came up with those numbers. All right, working capital and reserves. Your P&L expenses year to date were a whopping $123,811.93. That is your total operating expenses. Now, year to date, it's only 10 months, so we had to divide that by 10. That gave us a monthly expense burn of $12,381.19. Now, if you want working capital reserve, in place, you essentially want to multiply that by 3 months. You probably want to keep about 3 months worth of working capital on hand to cover all of your expenses, and it's based on what the historical expenses of the property are. That's a whopping $37,143.58. Now, working capital is a high-level buffer that protects against seasonality, which is huge in our market. All right, how I've always really looked at it is peak season is April through September. Now, the peak of the peak is June, July, and August for sure. But the point is, you need to make sure that you have extra working capital in place to handle the seasonality that hits our market, because it is a very real thing. Now, slow months, working capital is a high-level buffer that protects against seasonality. Slow months, liquidity shortages, unexpected revenue dips, and general operation cash flow needs. I've also got some reserves on here. You can see payroll float. Now, I basically took that 3.5% that I introduced to you earlier in the video of the effective gross rental income, which is a management fee, and I've put that in place for the in-house manager that's going to run the boutique hotel. Essentially, if you'll look on your screen, you can see I've put in a 60-day payroll float calculation. The management fee, 3% of the effective gross rental income, is a whopping $26,406.60. Your monthly payroll comes out to $2,640.66. So for 60 days, if we want to keep some extra capital in place for that employee, it's $5,281.32. That simple and that easy. So the next reserve line item I have is vendor lag calculation. We've got advertising and marketing. I've got you broken down for an annual and for a monthly. You can see these are the monthly vendor lag expenses. I don't want to go through all of them. You can see them right there on your screen. The monthly, it's got you at $9,145.76. So if we want a 45-day vendor lag reserve in place, because you're going to get services and you're going to get a bill later and then you're going to have to pay it, and obviously there's time in between when you get deposits and when the vendor does the service, you have to account for all that. The point is that if we've got 1.5 months that we've got for a vendor lag, and we've got a monthly vendor lag expense of $9,145.76, well, then the vendor lag reserve needs to be $13,718.64. Essentially, we took the 1.5 months and multiplied it by the monthly vendor lag expense. That simple and that easy. All right, so let's work through our next reserve, guys. Maintenance emergency reserves calculation. Essentially, we had repairs and maintenance annually to the tune of $14,000. We had some plumbing, we had some pool maintenance, we had some pest control. I broke those down into monthly. You can see there that the total maintenance or related spend for last year was $2,713.65. Well, if we want to make sure we have 120 days worth of maintenance emergency reserve funds, we simply take 4 for 4 months. We multiply it by $2,713.65, and we end up with a maintenance emergency reserve of $10,854.61. Now, before I get to your final reserve calculation, guys, what I want to point out to you is that field right there is where the Country Music Festival takes place each and every year. We're talking over 40,000 people. And your boutique hotel is like right over there. I'm just saying the location is absolutely phenomenal. All right, guys, so let's work through that insurance volatility reserve calculation. Year-to-date insurance cost for only 10 months was $18,808.92. Your monthly insurance cost then, of course, divided by 10 is $1,880.89. Then we've got to multiply that by 12 to get a full annual insurance cost calculation. That's $22,570.70. Guys, with a moderate coastal volatility factor for insurance of 20%, you need to keep about $4,514.14 in case the insurance rises on your boutique hotel. Now, some reasons why you might want to keep a reserve for both your property taxes and for your insurance. Very simply, guys, for a hotel, tax and insurance volatility reserve is going to cover year-to-year tax rate increases, countywide reassessments every 5 years that raise taxable value, large lump sum tax bills that hit once per year. You know what I mean? It's just smart to have that money saved. Unexpected adjustments or corrections made by the county, and then budget increases by the city or county that raise taxes. Guys, I'm going to take us a little bit further down while we finish covering the financials for this deal. All right, so we've covered commissions, legal, due diligence. We've got total closing costs. We've covered working capital. We've covered reserves. Let's get into your exterior remodel. According to my numbers, you can increase the occupancy for this boutique hotel by 11% in our market easily, which could equal for you an astounding $1.3 million in value. Because again, you're increasing the net operating income. I'm going to show you now how I arrived at that calculation. All right, so I want you to be at the top of the market as far as occupancy. You as an investor want to be at the top of the market as far as occupancy. Historically, they haven't been. 2024, 56.3, 2023, 57.9%, 2022, 54.5%. Guys, with optimization but not renovation. In other words, if we optimize the business, you could probably get the occupancy up to about 63%. If we make the exterior improvements, you can most likely get that occupancy up to about 67%. Now, we're talking top of the market occupancy target is an increase of 11% from where it sits. So essentially, the revenue benefit of the occupancy lift in 2024, that average daily rate was $161.97. Rooms available were 29. Room nights available were 10,585. Essentially, we did some math, and at 365 days per room, we ended up with the 10,585. Now, your occupancy target is 11%. So we're going to multiply that 11% by the 10,585 to arrive at the extra room nights that we want to grow into. We want to occupy another 1,164 nights. That would generate, at the current average daily rate, $188,593. Now, that's what we're going to set as our remodel budget, because we can get that back within the first year. And that's a smart move, because obviously you want to not be overextended in any form or fashion. You want to be able to get that money that you invest in it back immediately. And 1 year is a pretty short timeline. It keeps everybody focused on what they need to do to get that job done and to hit that level of return. So we've got an estimated remodel budget at $188,593. At 85% revenue flowing to the net operating income, in other words, the majority of that remodel is going to directly impact your net operating income. We're talking $160,304. At the 12.4% cap rate, guys, that's a value increase of $1,292,777. So what I just showed you was finding the weakest area in the property and improving it can add substantial value for the exit sale, which is what you want. In the next 5 years, by putting $188,000 into it, only having exposure really for a year, because you're getting it all right back, because once you upgrade that exterior, you're going to increase the average daily rate, which the majority of that money is going to directly trickle down into your net operating income, which is thereby going to increase the value of the property. We're getting back to the investment information. We are going to finish it, guys. All right, now, exterior remodel, we've got you at $188,593. So that gives us a total cost of investment of $4,636,606. Essentially, that's your purchase price, plus your closing costs, plus your working capital, plus your reserves, plus your exterior remodel. And again, that's going to leave you at a total cost of investment of $4,636,606. Now, your purchase price per unit is $146,552. Your total cost per unit, post remodel and reserves and all your other stuff, guys, we're looking at $159,883. Your going in cap rate again is that 12.4%. One thing I want to point out is there's not much difference between the purchase price per unit and the total cost per unit post remodel, which means that you're having a little bit of investment up front is going to give you a much larger return on the back end.
Now stay tuned, because coming up in the rest of the video, we'll do a 5-year projection on the property that shows the initial investment required to get into the deal. The mortgage data, the taxable income data, and the cash flow data, as well as 3 different cap rate scenarios for when you exit the investment. Oh, and don't miss my top market picks right at the end, based on which properties have appreciated the most and have the best annual profitability.
Now let's very quickly break down your uses and sources of funds so we know where the funds are coming from and how they're being used. Your purchase price was $4,250,000. Your closing costs were $126,500. Your working capital, $37,144. Your reserves, $34,369. Your exterior remodel, $188,593, for a total cost of investment of $4,636,606. Now, you got some loan fees. Your loan fees are $31,875. That's 1% of the purchase. Excuse me, it's 1% of the loan amount. Apologies. Now, if you add in those loan fees to the total cost of investment, you're going to be at $4,668,481. Now let's cover your sources of fund. Now on this model, I've only got senior debt. In other words, I've got you just using debt financing to purchase the property. We're going to a local bank here. We're getting you commercial financing. You probably have commercial financing for your other deals. You got a lender in place. I get it. Essentially, we're not using any junior debt. We're not using any other sources of debt. So we've got senior debt at $3,187,500, and that's it, for a total debt of $3,187,500. Now, there's no preferred equity. We're not bringing in any other partners on this deal. So your common equity, which is also your initial investment, is $1,480,981. All right, now as you can see back behind me, there are plenty of little shops. We do have this rig over here where they slingshot people up way high in the sky. A lot of people think that's fun. That's not for me. All right, so let's get into your 5-year pro forma. I want you to see, just at this quick intersection that's just up from the hotel, SkyWheel is right there. We have the Holiday Inn right here, which is a beachfront resort. We've got Riptide's oceanfront rooftop bar and grill, just that green building there. And then next to it, we have the Yachtsman, which is a redone oceanfront condo resort that's being sold by the unit. It just basically hit the market in the last 2 or 3 months. Pretty hot property. Further on down the way, I don't know if you can see it way down the way there, that big oceanfront resort. That's Ocean's One, which is it's a great place to invest in our market. This area is the area that you want to be in for a boutique hotel. Now, year one, we've got gross rental income to the tune of $708,372. That does include that 5% escalation in growth. Other income, $61,500. I'm assuming that within the first year, you're going to rent out and finish the space, that 5,000 square feet, for commercial use. And we're going to escalate it by that 2.5% commercial rent growth rate. Now, if you have 708 in income, in rental income, you add in the other income from the commercial space, you are left with a potential gross rental income of $769,872. Now, you have to factor in vacancy, guys. Lenders like to see vacancy. They like to see that you're accounting for revenue loss or vacancy. It makes them feel like you have a conservative, realistic grasp on your numbers. Ultimately, you always want to include it. That's $15,397. It's 3%. If you take $15,000 from the $769, yes, you have an effective gross rental income of $754,474. Now, operating expenses. Your property taxes for year one, $40,517.94. That does assume the 4% escalation in property taxes. Your other operating expenses. Essentially, this is all of the operating expenses you saw on the profit and loss statement, not including property taxes and or management fees, which we'll get into in a minute. Now, the other operating expenses were $127,593. 98. Your management fee was 3.5% of the effective gross rental income. That is a whopping $26,406.60. Real quick caveat here. If you do go with my plan and hire an owner-operator to run the boutique hotel, then you would be cutting out the property manager and reducing your operating expenses by $14,000. Now, yes, you would overall increase your operating expenses a little by having an on-site property manager, but there are certain efficiencies that you can create and performance that you can create by having an on-site person that I don't believe you can get with an off-site property manager. That's just my personal opinion. So your numbers can be adjusted a little bit to factor which scenario you'd rather go with. Now your management fee, again, that was $26,406.60. That's the payroll for your on-site property manager. Your reserve was $34,369. Guys, that's going to give you a total operating expenses of $228,887. If you take those total operating expenses from the effective gross rental income of $754,474, you are left with a net operating income of $525,587. Now, annual debt service, I've got you at $254,478. That's going to stay the same every year. Your mortgage is not going to change over that 5-year loan term. It's the same. I'm going to cover that data with you in a minute. Let's finish this out. Your equity cash flow, if we have a net operating income of $525,587, we subtract out annual debt service, our mortgage, we're left with an equity cash flow of $271,109. Yes, that is a cash-on-cash return in year one of 18.3%. It's beautiful. It's absolutely stunning. This is a phenomenal deal. It's a stabilized hotel. It is phenomenal. You got 3 years of solid data in place, which we're going to go over. You're going to see those occupancy numbers. 3 years of solid data in place for a first-time investor, another investor has already bought this property, upgraded it some, taken a lot of that supposed risk out of it, of finding the demand for it. And yes, you're basically stepping into a property that you can make some minor improvement to. You got stabilized income on it. There's not much risk in the deal, ultimately. Anyways, cash on cash, you can see there 18.3%. You can see years 2, 3, 4, 5, and 6. I've escalated all those years out based on our growth assumptions, as you already know. And you can see that cash on cash return is steadily climbing from 18.3 to a whopping 29.4%. Now, real quick, your total cash flow and returns. We're going to get into that just a little bit later in the video, so you got to keep watching. And as an investor, you want to know that math. All right, now let's work through that total cash flow and returns. Unleveraged, which means we did not use any financing. Your cash flow, first year, you're putting in $4,636,606. Year one, you're getting a cash flow of $525,587. Year two, you're getting a cash flow net operating income of $555,88. Year three, $586,120. Year four, $618,763. And then year five, we've got your net operating income at $653,098. Plus, you've got the sales price from selling the property coming in. Now, that's going to give you an internal rate of return to the tune of 16.12% unleveraged. That's if I paid all cash for this deal. Now, your leveraged return is going to look like only $1,480,981 coming out of pocket in the first year, because obviously it's negative for both of those, for both the leveraged and the unleveraged, because essentially you're spending that money. And then you've got coming in after that annual debt service, those equity cash flows of $271,109 in the first year. In the second year, $306,610. In the third year, $331,642. In the fourth year, $364,284. And then in the fifth year, you're going to be selling that property plus getting that equity cash flow of $398,619. That's going to give you an internal rate of return to the tune of 31.5%. It is absolutely stunning. Come on, guys. Now let's get into that reversion information. I get calls and emails every day from investors just like you looking to make their move into the Myrtle Beach market. They want to invest in short-term vacation rental properties. They want to invest in oceanfront condos. They want to know where the best deals are in our market. Well, guys, you're talking to the right person. 843-360-1737. I'm going to help you put your hands on the best deals in our market. If you're a first-time investor or a seasoned investor, if you're 1 year, 6 months, 3 years out, I don't care where you are in the investing process, pick up the phone, give me a call, send me an email, shoot me a text message, and let one of the many stories on our channel be one of your stories. Now I'm going to start to walk back to the property so again you can see just how close it is. Reversion information, your exit cap rate is 11.4%. In other words, I'm saying that our market is going to increase in value over the next 5 years. What you got to understand is we are the #2 vacation destination on the East Coast. 20 to 22 million tourists are visiting every single year. Additionally, we're one of the fastest growing markets on the East Coast because retirees, baby boomers, who are the wealthiest and largest generation in America's history, have figured out that they get the best bang for their buck here and not in Florida or in other coastal markets. Dollar for dollar, they get a whole lot more in our market. So they're moving here to the tune of over 90,000 people moved here just 2 years ago. 90,600. I haven't looked at your numbers for this past year, but the point is, lots of people are relocating and retiring at the beach, and this is the value buy on the East Coast. Plus, it's centrally located, so when their family visits, the family doesn't have to travel as far as like going to Florida. So what I'm telling you guys is our market is appreciating. I believe it's going to appreciate very well in the next 5 years. I believe our population is set to double in the next 10 years. So it's pretty clear with builders, with national builders building like it's going out of style in our market, expanding like wildfire, it is very clear that our market is the market to be in. Additionally, let's talk about the big boys. I believe it was Hilton. Maybe it was Hilton. Who was it? One of the major hotel players announced that they're going to be putting $100 million property in our market. We've got, who is it? I'm trying to think of who it is. It's a famous, not Jimmy, Margaritaville. They're putting a Margaritaville pool here right next to the Atlantica Resort. The point is, guys, that major players would not be investing in our market if there wasn't going to be a return. And if the major players are investing here and spending those marketing dollars, that's going to trickle down into business for your boutique hotel. There's no two ways about it. So your exit cap rate, 11.4%, totally doable. Your gross sales price then is going to put you at $6,045,720. Your transaction costs, you're going to have to pay 4% to sell it, 2% to a buyer's agent, 2% to a listing agent. Your net sell price then, after those transaction fees, is going to be $5,803,891. Now you can see that net proceeds at $2.8 million. That's after you pay off the loan balance. So you can see that 5.8 minus the $3 million loan balance is going to leave you with a beautiful $2.8 million. All right, so how is this investment going to impact me on my taxes? I'm glad you asked. Taxable income, guys. We've got you at gross rental income, $708,372 for the first year. We've got operating expenses at $228,887. That leaves you with a net operating income of $525,587. Your interest on your first year for the mortgage, you can write that off, $222,099. Your depreciation was $112,551. If you keep watching, I'm going to show you how I came up with that number. I'm going to show you a defendable basis that will hold up for calculating depreciation. Now, your amortization of loan cost. Essentially, they won't let you write your loan cost off all in the first year. It has to be over the lifetime of the investment. So we took your loan fees, 1% of the loan. We divided it by 5 years because you're holding it for 5 years according to this financial model. And we got you at $6,375 per year you're writing off of that you're not going to be paying taxes on. Now, your real estate taxable income, this is how it works. You take your net operating income, you subtract out your interest on the mortgage, you subtract out the depreciation, you subtract out the amortization of loan costs, that's going to leave you with $184,562 in the first year. Then I ran your numbers stating that you were at a 37% tax bracket. You're probably going to be in a much lower tax bracket. But the point is this, guys. At 37%, you're going to multiply that 184,562 by the 37%, and that's going to give you $68,287 that you're going to have to pay in taxes. That's your tax liability on this whole deal year one, which is phenomenal. Now, you got to keep watching because I'm going to cover your cash flow both before and after taxes. But before I do, let's take a look at your depreciation and understand how to come up with a defensible basis for calculating depreciation. All right, guys, I'm going to put this in the simplest terms I can. Depreciation, your original basis. You have a purchase price, $4.25 million. You've got acquisition cost. That's going to be broker's fees. That's $85,000. Essentially, that's going to be 2% of the purchase price. That's going to leave you with an original basis of the property. That's $4,335,000. Now, your basis of improvement. We've got the improvement value based on the tax assessor, based on the county tax assessor. The county tax assessor says that the improvement value on this property is $1,828,836. They also state that the total value is $2,454,811. So if we take that 1.8 improvement value, we're not factoring in the land in that improvement value. That's just the improvements on the property, and we divide it by the total value. That's going to give us a basis of improvement of 74.5%. In other words, the improvements on this property are 74.5% of the total value of the property. Now, your improvement basis. Our original basis that we came up with was $4,335,000. Our basis of improvement is 74.5%. We're here, by the way, guys. That's 310th, right back behind me. That close to the hottest spot in Myrtle Beach. All right, so your improvement basis. Your original basis was $4,335,000. Your basis of improvement was 74.5%. That's going to give us an improvement basis of $3,229,578. That's our improvement basis. That's our defendable basis for the improvements on the property that we need to be depreciating. Now, the IRS gives you tables. It's very simple. They give you tables for residential properties that are commercial residential properties and commercial non-residential properties. For those of you that don't know, an office building is a non-residential commercial property. It's that simple, that easy. A multifamily property is a residential commercial property. Now, they give you these tables for our purposes here and calculating a depreciation. I've essentially done an acquisition year. You can see there a holding year and a disposition year. I'm not going to get into the technicalities of it because I want to help the video go by quickly. And if you have questions about how I arrived at these numbers, just call, text, or email me. Ultimately, we're going to take the acquisition year at that $3.2 million, and we're going to multiply it by the residential acquisition year decimal that you see right there on your screen. Then that's going to give us $112,551. We're going to do the same thing for holding years 2, 3, and 4. We're going to take that $3.2 million, that improvement basis. We're going to multiply it by that holding year decimal for residential properties. And sure enough, we're going to get $117,427 for those 3 years. And then finally, in the disposition year, the year that we sell it, we're going to take that $3.2 million, multiply it by the decimal for the disposition year. It's going to give us $112,551. Essentially, the IRS is not going to let you write the property off for the entire year for depreciation. And just so that you know, they're only going to let you write it off for the time that you own it, and you have to take into account something called mid-month convention. It's that simple and that easy. If you want more technicals on it, just call me. Now, depreciation is wear and tear and economic obsolescence. As the property gets older, it loses value. As people use the property, depreciation is as people use the property, there's wear and tear on it. Economic obsolescence is new buildings are built, which means that older ones lose their value. So the IRS gives you a cool little write-off. Now, what I wanted to show you was all this traffic? This is Kings Highway, one of the busiest roads in our market, guys. As you can see here, this is boardwalk parking right here. There's a parking deck right here. It says, "We love the beach." You see it plain as day, guys. They wouldn't put a massive parking deck here if it wasn't a great location. They need parking because there's so many people that visit this location. It's the perfect location for a boutique hotel. I cannot stress it for you enough. Demand is here. Like, there's not a question of if demand is here. It is. And you're just about to find out when I cover your occupancy rates just how strong demand is here. Guys, it is definitely here. It's in this spot. It's established. And along this road, this is one of the busiest roads, if not the busiest road in our entire market. And your hotel is a block away. All right, you see I'm on Kings Highway. Super busy road, one of the heaviest traffic roads in our market. You see the massive parking deck. Do you see that little white building right there? That's the boutique hotel. The location is stunning. Let's get into our key performance indicators. Guys, occupancies first. 2024, 56.3. 2023, 57.9. 2022, 54.5%. All right, so it's consistent for 3 years right off the jump. That's the first thing I'm noticing. Strong demand. In other words, the majority of the risk is gone out of this deal because the property has proven to consistently demand rentals. So even if you're a first-time investor, you don't got to worry, is this property going to rent out? It's going to rent out. It's just a matter of if you're going to bring in right at 60% or if you can improve it and bring in that 80 to 85%. Can you get that value add out of the property? Do you know what to do to make it a top contender in this market? But the risk of not knowing if it'll rent is gone. 3 years worth of data. Now you'll also notice that there was a revenue jump in short-term rentals in 2023 compared to 2024. The point is they shifted the business model, the rental model. They were doing strictly short-term rentals in 2023, and it's the best performing year on the board. Now, average daily rate, we've got 2024, 161.97, 2023, 188.53, 2022, 188.03. Now, due to month-to-month rental shift, that's why it dropped from 2023 to 2024. It went from 188 to 161. And again, you know, the average daily rate, not the occupancy, is what determines the hotel's upside. The rental model correction is instant NOI increase. In other words, if you go back to focusing on short-term vacation rentals for this property, you're going to instantly increase the equity in the property. That simple and that easy, because the net operating income is going to go up. Now, RevPAR, that's revenue per available room, 2024, 91.11. It's obviously down from 2023 at 109.08 because they changed the rental model. They stopped doing the short-term vacation rentals and they started doing these month-to-month rentals. 2022 it was at 102.49. The important thing to take away here is that the average daily rate problem is it's not a demand problem. The location has consistent demand. Now we got TrevPAR. So the hotel, 2024 was 23,263. 2023 was 26,357, and 2022 was 14,438. That's total revenue per available room. Hotel is a RevPAR driven business, it's not an ancillary revenue business. So the total revenue per available room on this boutique hotel demonstrates that they're not getting the income from ancillary services, but from the true brick and mortar hotel business that it is. Now, we've got the gross operating profit per available room. 2024 was 19,640. 2023 was 22,738. 2022 was 10,815. Now, despite weaker pricing, hotel produced more profit per room. You can see in 2024. It's a strong flow through from efficient operation means that the average daily rate gains will convert to profits. In other words, the operations on this business are phenomenal, And if you can increase the average daily rate, it's going to directly correlate to profits. That's what you want. Now, the exterior remodel, therefore, is a must, because if you do the exterior remodel, then you're going to be able to increase the average daily rates. And since the business is operating so efficiently, it's going to trickle right into profits. The business itself is not going to eat up those extra profits, which is a really, really good sign, guys. This is a strong property, very strong property. Now, the cost per unit, the purchase price, we got you at, purchase price per unit was $146,552. That is between 35 and 50% below the replacement cost. For all of you developers out there, did you hear that? Yes. Now, the total cost per unit has you at $159,883. The rental costs have massive impact on net operating income, but not per unit cost, which is, that's what, I'm not asking you to put $1 million in the property. Now, your cap rate on the purchase price, you're at 12.4%. Now, the cap rate gap, the cap rate on the purchase price, you're at 12.4%. On the total cost, you're at 11.3%. The cap rate gap shows that you bought the property at a discount. It shows you instant value. Now, the gap shows a margin of safety and the embedded value add. You can see the difference there. We've got basically a 1.1% difference in cap rate from the purchase price to the total cost. And you're essentially looking at your margin of safety. If you just follow the plan and the model, you're safe and you're pulling that value right out of the property. Now, your operating expenses per unit, $7,892.66. Super, super low. You're as a percentage of effective gross rental income, you're at 30.3%. Your internal rate of return on leverage was 16.12. Your leverage was 31.05. Your equity multiple, guys, is $3.02. In other words, for every dollar that you're investing in this property, you're walking away with $3. Getting home to $3. Man, it's phenomenal. And then again, at the bottom there, you can see cash on cash return, which I've already covered with you. Guys, the investment's phenomenal. It's waiting on the right buyer. It is one of the best boutique hotels in our market, and you should buy it like yesterday. It is a no-brainer. Don't let fear stop you. Don't stop sitting on the sidelines. Pick up the phone. Give me a call. It's 843-360-1737.